Welcome to the Deep Dive. Today we're getting into a really interesting company, IQSTEL Inc. That's ticker IQSTD.
Yeah, they're a US-based multinational tech player.
And they're making some pretty bold moves. We're talking about their push for a NASDAQ listing and, well, this huge goal of hitting $1 billion in revenue by 2027.
Exactly. And we've got some great insight. Think of this as your backstage pass, really.
Right. Where's this coming from?
Our intel is straight from an exclusive interview with IQSTEL's CEO, Leandro Iglesias. It just came out yesterday, May 8th.
Okay, so fresh off the press, we can really break down his strategy.
We can really dig into what he said, what it means for the company, its path to NASDAQ, all that.
And IQSTEL, it's not just a one-trick pony, is it? They're into quite a few things.
No, definitely not. They've got their fingers in a lot of pies. Telecoms, FINTECH, cybersecurity, even some AI stuff.
So for you listening, our mission here is basically to cut through the noise. We want you to quickly grasp the key things driving IQSTEL's potential growth and, what this NASDAQ move really signifies.
Let's jump in.
Okay, first thing that jumped out at me, their share structure. It's really quite small, isn't it? Around 2.6 million shares. Outstanding. What's the story there? Seems intentional.
It is intentional. The CEO talked about this. It's the result of a reverse split. And the idea behind keeping it lean is actually kind of investor-focused.
How so?
Well, the thinking is with fewer shares floating around, any good news or, a sudden increase in buying, it could potentially move the stock price up more quickly, more dramatically.
Okay. Less supply, potentially bigger reaction to demand. Makes sense.
It sort of amplifies things. And the CEO was clear, they're not just looking for any investors.
Who are they targeting then?
They want long-term, value-focused investors. He specifically mentioned institutions. The lean structure is meant to signal financial discipline and a real focus on shareholder value. That appeals to the more serious money.
Got it. Okay, so that structure sets the stage. Yeah. Now the big move, getting off the OTC market and onto NASDAQ.
Yeah.
Why is that such a game changer?
Oh, it's huge. I mean, stepping up to NASDAQ brings immediate benefits. First off, just way more visibility.
More eyeballs on the company.
Exactly. And NASDAQ's listing requirements are tougher than OTC, so just being there gives the company more validation, credibility in the eyes of many investors.
It's like graduating, moving up to the big leagues.
That's a good way to think about it. And that validation opens doors to a much wider pool of investors, people managing way more capital.
Any examples of how the OTC listing holds them back now?
Yeah, the CEO actually gave one. He talked about strong interest from investors in the UK, but they just couldn't easily buy the stock because it was on the OTC. NASDAQ solves that. Global access, basically.
Okay, so it removes those barriers. And it's not just about individual investors having easier access, right?
No, not at all. Think bigger. Family offices, institutions, large funds, a lot of them have rules. Mandates that say no OTC stocks or nothing under $3 or whatever.
So getting on NASDAQ puts them on the radar for these bigger players.
Precisely. They instantly become eligible for watch lists they weren't even on before. That's where their investment bank partner, Alliance Global Partners, comes in too. Their job is to tell IQSTEL's story to that global network.
Let's talk mechanics then. They're doing a direct listing, not raising money with the uplist. The CEO really hammered this point home as being good for shareholders. Why is that so important?
It's all about avoiding dilution. Normally, when companies uplist, they often sell new shares to raise cash.
Right, which means more shares out there, cutting into existing shareholders' slice of the pie.
Exactly. But IQSTEL says they already meet the equity requirements for NASDAQ, so no need to issue new shares right now. This direct listing protects the value for the people who already own the stock. It's a key differentiator, he argued.
And their debt situation helps with this too, doesn't it? He mentioned something about that?
Yeah, good point. He highlighted they only have one lender with convertible notes, and crucially, those notes don't mature until 2026.
So no immediate pressure to convert that debt into stock.
Right. Convertible notes can sometimes hang over a stock if there's pressure to convert and sell. But with the 2026 maturity, that pressure is off for now. The CEO's message was clear. They want to bring new NASDAQ investors into a clean, tightly managed cap table with management focused on the long game.
Okay, let's shift to the valuation story. The numbers are pretty stark. $283 million revenue in 2024. That's about $1.40 per share. But the market cap is only, 10% of that revenue?
Yeah, it's a huge disconnect on the surface.
How does the CEO explain that gap? That seems like a major undervaluation.
He pins it squarely on the OTC listing. His argument is basically that OTC stocks just don't get the same level of interest, especially from institutions. They're off the radar for many.
So he sees the NASDAQ uplisting as the fix.
Pretty much. He expects it to be self-correcting. Once they're on NASDAQ, accessible to institutions, accessible to a wider global retail audience, the market should start pricing them more appropriately based on their fundamentals. Remember, market cap is just the total value of all shares. Having it be such a tiny fraction of annual revenue suggests the market isn't giving them much credit right now.
And going back to that small share count,
Yeah.
the float, that could amplify any new buying interest from NASDAQ investors, couldn't it?
Absolutely. The CEO mentioned the small float specifically. Fewer shares available means new demand could theoretically push the price up more sharply. He also pointed out that many telecom companies on the big exchanges trade at, 1x revenue or even higher.
Even ones that aren't growing much or aren't profitable.
Sometimes, yeah. And then you look at IQSTEL.
Their growth was huge, wasn't it?
96% year-over-year revenue growth. Plus, they have this proven revenue base, a global platform that can scale, and they're improving profitability. So from the CEO's perspective, the current valuation just doesn't reflect those strengths at all.
Let's look closer at those financials. He gave some early numbers for Q1 2025. What stands out there?
Well, the trend is positive across the board, which is what you want to see. Net revenue for Q1 was $57.6 million. That's up 12% from Q1 last year.
Okay, decent top-line growth.
But look at the gross profit, $1.93 million. That's up 40%. That's a big jump.
Wow, 40%. So they're keeping more of each dollar of revenue.
Exactly. The gross margin improved significantly, up 25% to about 3.36%. That's a key indicator of improving efficiency and profitability. Plus, positive adjusted EBITDA in their main telecom division.
And this is coming off a strong end of 2024, too.
Yes. Q4 2024 revenue was $98.8 million, so they had good momentum coming into this year. He also threw in an interesting tidbit. Historically, their second half of the year is much stronger than the first.
Suggesting maybe even better numbers later in 2025.
Potentially, yeah. And one more number he kept bringing up. Total assets of $79 million. Again, contrasting that with the current low market cap.
So fast forward, they get on to NASDAQ. What's the expectation then? How does the market react?
The core expectation is a re-rating, a significant one. The CEO believes the market will start valuing IQSTEL more like other tech and telecom companies on the national exchanges.
You mentioned multiple starting around 1.0 times revenue for peers.
Right. And IQSTEL is currently trading around, 0.07 times its 2024 revenue. Even based on their 2025 forecast of $340 million, it's still incredibly low compared to that benchmark.
So you take $283 million revenue, growing fast, improving margin, $79 million in assets, and compare it to a 0.07x multiple. It does seem out of whack if they execute.
That's the argument. Now, of course, getting listed is one thing. They'll need to keep delivering on growth and profitability to convince the market they deserve those higher multiples long term. It's not automatic.
Sure, visibility helps, but performance has to back it up.
Absolutely. But the expectation is continued revenue growth, better EBITDA, margin expansion, more investors paying attention, and maybe even better opportunities for strategic acquisitions.
He also talked quite a bit about the foundation of the business itself. Years of work building technology, relationships.
Yeah, he emphasized that this isn't an overnight thing. They've spent years on tech development, building trust with partners, getting those interconnection deals with major global networks.
Sounds like a high barrier to entry for competitors.
That's the point he was making. They have this established global network, customers, vendors, hundreds of millions flowing through it annually. You can't just replicate that quickly or easily. It gives them a moat,
A competitive advantage. And does that existing infrastructure help them grow more easily now?
Definitely. He talked about scalability. The idea is they could potentially double their current revenue without needing to double their operating costs.
So growth could become increasingly profitable.
That's the potential. More revenue drops faster to the bottom line because the core infrastructure is already there. So the focus now is leveraging that base for profitable growth, maybe expanding into higher margin services.
Okay, finally, let's loop back to that big target, $1 billion in revenue by 2027.
Yeah.
He still sounds confident.
Very confident. He reaffirmed it's realistic and actually believes the NASDAQ listing makes it more achievable.
How does the listing help reach that specific revenue goal?
Well, partly the visibility and credibility helps in winning bigger deals, maybe attracting partners. But he also points to their diverse business telecom, AI, fintech, cybersecurity operating in over 20 countries with a solid team. It's about leveraging all those pieces, powered by the enhanced profile and potential access to capital that NASDAQ brings.
Again, that potential re-rating, the small float.
Yeah.
He sees that momentum helping too.
Yeah, he believes getting valued closer to industry peers, maybe starting at that 1.0x revenue multiple, combined with the small float dynamics, could create significant positive momentum if investor interest picks up as expected post-listing.
Okay, so let's try and sum up this deep dive on IQSTEL based on that CEO interview. We've looked at their deliberate lean share structure,
Right, designed to potentially amplify gains.
the expected big benefits from uplisting to NASDAQ, more visibility, wider investor access, and doing it via a direct listing, which avoids diluting current shareholders.
Uh-huh. We also talked about their strong financials, that 96% growth, improving margins, and the clear disconnect the CEO sees between that performance and their current OTC market valuation.
And his continued confidence in hitting that quite ambitious $1 billion revenue goal by 2027, boosted by the NASDAQ move.
So for you listening in, the key thing to grasp here is you've got a company seemingly at a turning point. It's making a strategic shift to a major exchange, which could potentially unlock significant value and growth if the market responds as the CEO anticipates.
It really puts them in a different league, potentially.
It could, yeah. Access to a whole different class of investors.
All right, so here's something to chew on after we wrap up. Considering IQSTEL's growth, their tech mix, and this NASDAQ catalyst,
Yeah.
what are the curveballs? What unforeseen tech disruptions or big market shifts out there could either supercharge their path beyond 2027 or maybe throw a wrench in those ambitious plans?
That's a great question. Always have to consider the external factors.
Definitely food for thought.
Yeah.
Thanks for joining us for this deep dive.